Sunday, January 18th, 2026. Welcome to the Deep Dive. We are looking at the markets this morning through the lens of the vivimoneyDaily report. And, if you're just glancing at the headlines, you might think it's business as usual.
Right.
But when you look at the data, the actual raw numbers we have in front of us, the signal is it's flashing red.
Oh, it's definitely not business as usual. I mean, we are seeing a kind of structural break in how the market usually functions.
Also,
Well, typically, mid-January, you get that new year, new money inflow. You get optimism.
sure.
Instead, what we have here is a market that is, I guess, technically holding up. The prices are high.
The foundation is shaky.
My foundation is absolutely shaky.
And that's exactly what we need to decode today. We have a very specific mission for this deep dive. We're looking at a market with let's call it a split personality.
That's a good way to put it.
On one side, you have the attack portfolio AI, tech, growth, all betting on a massive boom. On the other side, you have the defense portfolio, gold, silver, even Bitcoin betting on a collapse. And the craziest part, both sides are winning at the same time.
Which just shouldn't happen. In a textbook economy, money flows into risk or it flows into safety.
Right, one or the other.
It rarely floods into both simultaneously with this level of aggression. It tells us that investors are confused, or maybe they're just hedging against two completely different futures.
Okay, so let's start with the timeline that has everyone so worried, the macro environment.
Yeah, the big picture.
The report leads with interest rates, specifically the 10-year Treasury yield. And I'm looking at the chart, and it is just stuck in a very tight band between 4.1% and 4.23%.
And that number right there is the first anomaly. We really need to unpack why 4.2% is so significant right now.
Okay.
Remember, the inflation data we've been getting, core CPI, the PCE, it's been cooling. The whole narrative for the last 6 months of 2025 was inflation is beaten, rates are going to fall.
Right, rate cuts are coming.
Exactly. If that were true, the 10-year yield should be diving maybe towards 3.5%. But it's not. It's refusing to budge below 4.18%.
So the market is demanding a higher payout to hold U.S. debt, even with inflation dropping.
Yeah.
That suggests the risk isn't inflation anymore.
Precisely. The risk has shifted. It's gone from economic risk, prices going up, to political risk.
Wow.
And the report highlights this looming shadow over the Federal Reserve. We have news cycles just dominated by these legal challenges and political maneuvering around Jerome Powell and the Fed's independence.
And we don't need to get into the partisan side of it, but just from a market mechanic perspective, if investors believe the Fed is being politically strong-armed, what does that do to the yield?
It adds what I'd call a chaos premium. If the bond market thinks rate cuts are coming because of political pressure, not because of economic necessity, they lose trust in the currency.
So they demand more to hold it.
They demand a higher yield to compensate for that institutional instability. And that is why we are stuck at 4.23%. The market is pricing in a potential loss of central bank independence.
And while the Fed is caught in this political vice, the actual economy, the engine on the ground, is starting to sputter. We have the December employment numbers in this report.
And they're sobering. Non-farm payrolls for December came in at plus 50,000.
Plus 50K. I mean, for context, through most of 2024, 2025, anything under 150K was considered a miss. 50K is stalling speed.
It's a dramatic deceleration, and the unemployment rate is now sitting at roughly 4.4%.
Which historically isn't a catastrophe.
No, 4.4% isn't a depression, but the rate of change is the red flag. We've gone from a super hot labor market to just a cool one very, very quickly.
And in a normal world, the Fed would see plus 50K jobs and cut rates immediately to support the economy.
They would, but they can't. Because if they cut now, with all this political pressure swirling around...
It looks like they're capitulating to the politicians.
Exactly. They are paralyzed. And that paralysis is creating a liquidity problem in the, let's call it the banking plumbing.
Okay.
The report points to the ONRRP, the Overnight Reverse Repo Facility, and the SRF, the Standing Repo Facility.
All right, this is the plumbing section of the report. It's a little dense, but it's crucial. We saw a massive spike in usage on December 31st.
Huge spike. Think of these facilities as emergency pawn shops for banks.
Yeah.
When banks have plenty of cash and they trust each other, they lend to each other. When they don't trust the system, they park cash at the Fed, that's the ONRRP, or they grab emergency cash from the Fed, that's the SRF.
So that year-end spike means banks were hoarding liquidity.
They were hoarding. Even though the report says M2, the total money supply is huge at $22.3 trillion.
How does that work?
It means the ocean is full of water, but the pipes are clogged. There's $22 trillion out there, but it's not moving efficiently. That tells us that underneath this calm stock market, the banking sector is bracing for impact.
They're building up their cash buffers.
They foresee volatility.
Speaking of volatility, let's talk about the VIX. Because looking at the fear index, you would not know any of this is happening. The VIX is sitting at, what, 15.8?
15.84 as of January 15th. It is suspiciously low.
Is that just complacency?
It is extreme complacency. But the report frames it a little differently. It calls the VIX a coiled spring.
A coiled spring.
Yeah. When the VIX is this low in a high-risk environment, that means insurance is cheap. But it also means the market is totally ill-prepared for a shock.
So a bad headline hits.
And that 15.84 doesn't just drift to 18, it gaps. It jumps to 25 overnight.
So the stock market is sleepwalking. Meanwhile, the crypto markets have woken up. Sentiment there has shifted from extreme fear all the way back to greed.
The crypto fear and greed index is at 60. That's the greed caution zone. It's a fascinating divergence.
It really is.
The bond market is terrified, so yields are up. The stock market is asleep, VIX is down, and the crypto market is getting greedy. These signals just contradict each other.
And what's holding it all together? The dollar. The DXY is at 99.3.
Which is structurally strong. And a strong dollar usually suppresses asset prices, right? Especially commodities. But as we're about to see when we get to gold, the old correlations are breaking down. The dollar is strong, but assets are rising anyway.
Let's get into those assets. We mentioned the barbell strategy. Let's look at the attack side first. The growth stocks, the AI trade.
Okay. The report tracks the majors. We've got VOO, the S&P 500 ETF, trading around $636. QQQM, the NASDAQ 100, is around $256. But the critical note here isn't the price, it's the volume. The report describes the volume as thin.
And why does thin volume worry you in a rally?
Because thin volume means the conviction isn't deep. It means the price is being pushed up by a small number of trades. So when volume is thin, the market gets fragile.
What happens if selling pressure hits?
The price can drop right through the floor because there are no buyers layered underneath. It's like walking on thin ice. You're moving forward, but the surface isn't stable at all.
And who's leading this charge across the ice? NVIDIA. NVIDIA is trading at, what, roughly $186.2.
Still the undisputed leader of the pack. But the report flags two specific risks for NVIDIA: China orders and supply rhythm.
Talk to us about the supply rhythm.
It's really the logistics of the whole AI boom. NVIDIA has the demand. I mean, everyone wants their chips. The question is, can they ship them fast enough? And specifically, can they navigate the export controls to get them to the Chinese market without triggering U.S. sanctions?
So any hiccup gets punished.
At 196 a share, the market is pricing in absolute perfection. Any hiccup in that supply chain gets punished instantly.
We also see Meta and Alphabet in here, continuing their heavy CapEx spending. But the report goes deeper on the attack side. It mentions something called pre-stocks.
Ah, yes. This is the Wild West. We are talking about companies like Anthropic, xAI, and OpenAI.
These aren't public. You can't just buy them on Robinhood.
No, they trade on secondary markets. And the report comes with a massive warning label here.
Which says what?
Wide spreads, poor liquidity, high risk. When you buy stock in a private company on one of these markets, you're often paying a huge premium. The spread between what buyers want to pay and what sellers want can be 10, 15, even 20%.
And if you need to sell to raise cash?
You can't. You are locked in.
So the advice is, don't chase the hype in the private markets unless you can afford to lose that liquidity.
Exactly. Keep those positions tiny. Speculative. Do not treat OpenAI shares like a savings account.
Okay, that's the attack portfolio. Now let's flip to the other side of the barbell. Defense. This is where the data gets truly historic. I'm looking at the price of gold in this report. $4,594.
It is staggering. I mean, just a few years ago, we were talking about $2,000 as the ceiling. Now we are closing in on $4,600. And silver is joining the run, trading at historical highs of $89 to $90 an ounce.
But you said earlier that inflation is cooling. Usually gold is an inflation hedge. If inflation is down, why is gold going vertical?
Because this is not an inflation trade. This is a systemic risk trade.
Okay.
Capital is moving into gold not because people think milk will cost more next month, but because they're worried the currency system itself is becoming unstable because of that political pressure on the Fed we talked about.
So gold is the asset you own when you don't trust the government's ability to manage its debt.
It's the I don't trust the pilot insurance.
Got it.
And we are seeing the exact same behavior in digital gold. Bitcoin is consolidating in that $95,000 to $96,000 range.
It feels like it's just waiting to break that six-figure seal.
It is. The big resistance level is at $98,000. It needs a push from the ETF inflows to get through it. But there's a metric in the report that I find incredibly telling: the Bitcoin to gold ratio.
And what is that ratio telling us right now?
It's sitting between 20.6 and 21.0. That means one Bitcoin is worth about 21 ounces of gold. The stability of that ratio is the key.
Why is that?
It shows that Bitcoin and gold are moving in lockstep. Bitcoin isn't behaving like a volatile tech stock anymore. In this cycle, it's behaving like a reserve asset. It has sort of graduated to the defense side of the portfolio.
Twin pillars of safety. One physical, one digital. What about the rest of the crypto market? Ethereum? Solana?
Well, Ethereum is basically following Bitcoin, trading between 3,100 and 3,300. It's acting as a high beta version of Bitcoin. Solana is the wildcard super volatile, trading between 130 and 140. It's capturing the purely speculative money.
And then the report mentions HYPE.
The meme coins.
Yes.
The gambling tokens. The report is very clear on this. High speculation, wide platform spreads. This isn't investing. It's entertainment with financial consequences.
So radioactive.
Treat HYPE assets as radioactive. Fun to look at, very dangerous to hold.
Okay, so we have the landscape, a paralyzed Fed, cooling jobs market, complacent stock market, and a massive rush into both AI for growth and gold for safety. The question for you listening is, how do you navigate this week?
And the report outlines a strategy. It calls it the barbell strategy.
Right.
And the logic is simple. Don't try to predict the winner. Own both ends of the outcome.
Okay, break it down for us. Step one is defense priority.
This is your core. The report advises keeping the bulk of your capital in the broad indices VOO and QQQM. Despite the thin volume, you need that market exposure. If the melt-up continues, you have to be in the boat.
Don't get cute.
Don't try to stock pick your retirement account right now.
Okay, step two, accumulation.
This is where you get tactical. The report suggests a dollar cost averaging, or DCA, approach for the leaders. That means buying small amounts of NVIDIA, Bitcoin, Ethereum on a regular schedule.
Not all at once.
Do not lump sum your cash in right now. The market is just too fragile. Spread your buys out.
And it mentions using options for protection.
Yes. Because of that political risk we discussed, it recommends using options, specifically puts or collars, to hedge your downside. Think of it as paying a small premium for fire insurance.
So if the Fed news turns ugly and the market drops 10%?
Your options positions will gain value and they'll offset some of the losses in your stocks.
And finally, step three, liquidity. The report uses this term, duration gradient.
It's a fancy term for a very simple concept. Keep cash available. Don't lock up all your money in long-term bonds that you can't sell easily. The report emphasizes keeping this duration gradient, meaning owning some short-term bills and, actual cash.
Why is cash so important right now?
Because of those plumbing issues we saw on December 31st. If there is a liquidity crunch, a moment where cash just becomes scarce asset prices will crash temporarily.
And if you have that dry powder,
you can buy high-quality assets at a massive discount. If you're fully invested, you're just a passenger on the roller coaster.
So stay nimble, don't be fully leveraged.
Exactly. Cash is a position. It is an active, strategic choice.
What are we watching this week? What triggers the next move?
It is all eyes on the Fed. We need to watch the PCE data release. That's the key inflation print. But I think more importantly, watch for any speeches from Fed officials.
What are you looking for?
The market is desperate for a signal on how they are handling the political pressure. If a Fed governor comes out and really asserts their independence, yields might drop. If they sound hesitant, yields could spike higher.
And we also need to watch the ETF flows, specifically for Bitcoin, to see if we finally get that break above 98K.
Correct. The flows will tell us if the big institutional money is coming back after the holiday break.
This is such a unique moment. Sunday, January 18th, 2026. We're standing on a fault line between a new technological era with AI and, I guess, an old-school crisis of confidence in our own currency.
That is the perfect summary. We are building the future with NVIDIA while we're hedging against the collapse of the present with gold. It's a paradox, but it is the only rational play right now.
Before we sign off, I want to go back to something you hinted at earlier, this idea of the trust premium.
It's the thought that keeps me up at night.
Leave the listener with a final question to chew on regarding that.
The question is this. We spend all our days analyzing data. We look at CPI, we look at payrolls, we look at supply chains, and we assume that if the data is good, the market goes up.
Right.
But what if the political pressure on the Fed becomes the only variable that matters? If the market decides that the Fed has truly lost its independence, will we stop caring about inflation data entirely? Will we enter a phase where yields rise and stocks fall simply because the referee of the economy has been compromised? If that happens, the old playbook doesn't just stop working, it gets thrown out the window.
A loss of faith is much harder to fix than a loss of jobs.
Exactly. You can print money, but you cannot print trust.
On that note, stay hedged, stay curious, and keep your eyes on the plumbing. We will catch you on the next Deep Dive.
Stay safe out there.